Alright guys, so moving on to Unit 16 to finish up Lesson 5. So Unit 16, we're finishing up Lesson 5. So real estate financing practices. Okay, this is what we will identify, describe, and explain and distinguish. So the financing market. So we have to talk about the Federal Reserve System. The Federal Reserve System divides the country into 12 Federal Reserve districts, each served by Federal Reserve banks, and nationally chartered must join and purchase stock in the district reserve banks. So, for the banks that want to be certified FDICA, I believe, they have to be part of the Fed system, and the Feds are the ones that actually loan money to the banks. So they actually don't fall under a federal, under the national federal branches. They're kind of their own entity, and so when we talk about rates, we're not talking about rates as far as mortgage rates go. So the rates that they talk about, when you see them like a couple of months ago, they were very, very low, maybe like 1.75 or 0.75, something like that. That's the rate that they loan to the banks, and then the banks could pass through the savings in order to lower down the interest rates of mortgages. So the mortgage banks are the ones that deal with mortgage rates, and the regular rates or interest rates, the Feds dictate that, but that's not for the public. That's more for the banks. So the reserve requirements. The Fed requires that each member bank keep a certain amount of assets on hand as reserve funds, unavailable for loans or any other use. This protects customer deposits and provides a means of manipulating the flow of cash in the money market. As a principle, when the money available for lending decreases, interest rates rise. By decreasing reserve requirements, the amount of money circulating in the marketplace rises, causing interest rates to drop. The discount rate. The discount rate is a rate charged by the Federal Reserve when it lends money to its members' banks. The prime rate is strongly influenced by the Fed's discount rate. Okay? So, by the Fed's discount rate. Okay. So the primary mortgage market made up of lenders that originate loans. So these are like, I call them like the small banks. Okay, could be Chase, could be lenders, could be whoever it may be that loans out money or mortgages. This is what some of the primary mortgage market is made up of. You see like credit unions, pretty small, investment group financing, insurance companies, kind of small as well. In Illinois, the Secure and Fair Enforcement of Mortgage Licensees Act of 2000, which is called the SAFE Act, requires that each individual state must license and register mortgage loan originators. So, loan originators do need a license. Illinois is also a participant of the nationwide mortgage licensee system called the NMLS. So you will find a NMLS number associated to lenders, requiring that all MLOs to register, and it requires an 8-hour continuing education course. The secondary mortgage market are the big banks. Right, or the I don't want to call them banks, but the big honchos. So we have Fannie Mae, Ginnie Mae, Freddie Mac. Fannie Mae is government owned. Ginnie Mae is a division of HUD. Freddie Mac is now government owned as well. Fannie Mae is government owned, deals with conventional, FHA, and VA loans. Okay. Fannie Mae buys a pool of mortgages which may be used as collateral for mortgage-backed securities that are sold on the global market. So just imagine a big pool, and then all these little small loans in it that they get from let's say Chase or guaranteed rate, mortgage banks, such of that nature. We have Ginnie Mae, which is a division of HUD, administers special assistance programs and guarantees mortgage-backed securities using FHA and VA loans as collateral. Freddie Mac is now government-owned, provides a secondary market primarily for conventional loans. So with these, with Freddie Mac, Fannie Mae, they're the ones that back up the VA loans, and they back up any like IDO programs or FHA programs that are out there. Straight loans are also called interest-only loans. Essentially divides the loans into two amounts, interest and principal, to be paid off separately. Interest first, then principal. Amortized loans or direct reduction loans. Every time we pay, the first month, second month, third month, every time we pay into an amortized loan, we increase our, so the first couple of years, we have an increase in interest, and then at some point, we now start paying more principal than we do interest. So let's just say, I don't know, on year 10, say this is year 10, we now shift and we now pay more in principal than we do in interest. So all amortized loans are usually interest heavy, okay? And this is what people look at when they look at their monthly payments, okay? So every single month, your interest, you're going to pay high interest, but then your principal starts going lower, lower, and lower, eventually where you start paying more principal than you do interest. Adjustable mortgage rates, so they fluctuate, okay? Basic variables. A loan originated at one rate of interest that fluctuates up and down during the loan term based on some objective economic indicators called an adjustable rate mortgage, or an ARMS. Rate caps, rate caps limit the amount the interest rate may change. Rate is tied to an index. Payment caps are set a maximum amount for payments. Adjustment periods establish how often the rate may change. So usually, since we are in a very low interest rate time period right now, I don't think anyone would actually use a adjustable rate because interest rates are very, very low. A balloon payment. The best way we could explain a balloon payment is like this. So think of you guys already know that my drawings are awesome. So when we think of a balloon payment, so let me draw this a little bit better. So we pay, right, little at a time, and at some point what's going to end up happening is the payment blows up like a balloon. Okay, so when the periodic payments are not enough to fully amortize the loan by the time the final payment is due, the final payment is larger than the others. Okay, so so they're telling you that you're going to pay monthly, and then at some point the final payment blows up, and that's why a lot of people get in trouble with balloon payments. Growing equity mortgage. Usually fixed interest rate, but payments of a principal are increased according to an index or a schedule, or also known as GEM. GEM is most frequently used when the borrower's income is expected to keep pace with the increasing loan payments. A reverse mortgage. So reverse mortgage is for kind of like senior citizens. I'm sure you guys probably heard of this stuff on TV. And so basically what it is a loan based on the equity the homeowner has invested in the property. Allow senior citizens on a fixed income to draw on the equity they have built up on their home without having to sell. So most people pay off their houses, once they're a lot older. So what will end up happening is, let's say they have, 200,000 in equity. What they'll do is, instead of that, they were paying banks, so now, an investor or a bank will come, they'll give them the 200,000, right, or whatever equity is inside the property, and then they'll do monthly payments, and then, maybe the monthly payments are 1,200 a month, and that's what they will now pay out to the senior citizens. Okay. And this is usually done, for people that aren't leaving their house to someone, or maybe they just want to, a little bit better, more retirement, whatever the case may be. This is an option that they could do. Non-recourse loan. The loan is sometimes called no recourse loan that allows the borrower to escape personal responsibility on the loan. The lender's only remedy is to take over the property. Okay. You probably won't see this much from lenders. Why? Lenders always want their money. Loan to value ratios. Okay. So the ratio of debt to value of the property. The lower the ratio of debt to value, the higher the down payment by the borrower. The higher down payment means a more secured loan, which is minimize the lender's risk. The best way I could tell you guys to remember this stuff is, so on a VA, we are 100% financing, right? Meaning 0% down. Okay. Let's say we have a loan to value ratio of 95%, meaning we have to put 5% down. Okay. So you guys see this? The lower the loan to value ratio, the higher the down payment. Okay, so if we have 90% loan to value ratio, how much is the down payment going to be? 10%, right? But you see, the lower it goes, the higher the down payment. Okay, that's loan to value ratio. Conventional loans. The biggest things you have to remember on conventional loan is conventional loans deal with PMI, private mortgage insurance. Those private mortgage insurance, it's basically for people that didn't put enough down, or maybe the 20% down, so they get charged something called PMI. FHA has something called MIP. Okay, FHA has something called MIP. So FHA has prepayment privileges, low down payment loans, and discount points. VA guaranteed loans has no MIP or PMI. Okay. Certificate of eligibility. So if you want to be a good point of contact for VA loans, understand how to get the certificate of eligibility for the clients, which some lenders could do. Certificate of reasonable value, reasonable discount points, prepayment privileges, and then assumption rules. So VA loans can be assumed by other veterans. Agricultural loans, we have Farm Service Agency, we have a Farm Credit System, and a Farmer Mac. So government-based enterprise that operates similarly like Fannie Mae, Freddie Mac in context of agriculture. These are some type of financing techniques. So if you want to pause here, you guys can. So we have purchase money mortgage, which is seller financing. We have package loans, includes personal property as security for the loan in addition to the actual real estate. So personal property could be a car plus the house, right? A package loan. A blanket loan covers more than one parcel of land. So kind of like developers, right? Wraparound loan enables a borrower with an existing mortgage to obtain additional financing from a second lender without paying off the first lender. So here's your first mortgage, and then your second loan would wrap around that one. Okay. Open-end loans secures a note plus any future advances of funds. Open-end loan secures a note plus any future advances of funds. Construction loan, also called interim financing. The lender commits to the full amount of the loan but disperses the funds in payments, draws during construction work for the work that has been completed. So let's take a FHA 203K, which just know that it deals with fixing up the properties. So here's draw 1, draw 5, 1, 2, 3, 4, 5. So the first one might be the down payment that will help the contractor get material and things like that. Let's say they do a draw here, but let's say they've spent all the money before they get the third draw. Guess what? Someone has come up with that money. Okay, so this is it's not a hard loan to do, but the process itself is a little bit more complicated than most people seem to realize. Sale leaseback. The property is sold and then released back to the seller, who continues to conduct business on the property as a tenant. Remember, if this is Bob the builder and he has a little factory, he needs, let's say he needs capital, right? So he'll sell it for money, and the new buyer will lease it back so that he could still conduct business there. Okay. Other financing techniques: buy downs, which the lump sum is paid in cash to the lender at the closing that reduces the interest rate. So buy down, So the buy downs, it allows people to buy down their interest rate. Home equity loan are also called HELOCs. So basically what it's used for, the lender extends a line of credit that the borrower can use whenever needed. Mostly they're used to fix up the house, or whatever it may be, but that's what they use it for. Okay. Truth in Lending Act, also called Regulation Z. Regulation Z, make sure you guys study this, or at least have a notion of it. So the creditor, so you have the creditor, you have 3-day right of recession, you have advertising, and you have penalties. Okay. So changes became effective October 1st of 2015. So a little bit on that. What we're saying is, for the creditors cannot ever discriminate against any of the protected classes. Okay. And as far as 3-day right of recession, as long as it's not a first mortgage, your clients do have the right to rescind the contract within 3 days. Okay. So a borrower has 3 days in which to rescind the transaction by merely notifying the lender. The right does not apply to residential purchase money or first mortgage, so seller financing or the first mortgage. Advertising the annual percentage rate. APR must be stated. Specific credit terms such as down payment, monthly payment, dollar amount, or of the financing charge or terms on the loan may not be advertised unless the advertisement includes information. So when people are advertising, like loan officers, they need to advertise the APR. Sorry, APR, just like a car. And there is many fees and penalties that can be issued. Equal Opportunity Act, again, we cannot discriminate again, or lenders cannot discriminate against credit applicants on the basis of race, color, religion, national origin, all that stuff. Lenders must inform reject applicants' reasons for denial. Financial institutions are expected to participate in local community development, which is the Community Reinvestment Act of 1977. And then RESPA. RESPA designed to ensure that the buyer and seller are both fully informed of settlement cost. Okay, so when we get a CD or disclosure or the HUD statement or settlement statement or master statement, the day of closing, all the costs, including your commission and the seller's commission, will be on that statement. And the attorney will go over that statement with the clients. TRID, TILA and RESPA integrated disclosures rule. So we need so it must be delivered 3 days, 3 business days after the application. Sorry. So sometimes your closing might take another 3 days once you get a clear close, because what ends up happening is they have to follow the TRID rules. What are the advantages of purchasing a home with an FHA insured loan? Low down payment, people with credit issues and things like that are able to purchase a house. Advantages of a VA loan: 100% financing, so the veteran doesn't have to pay anything down. Disadvantages: the houses are more strict, right? It has to be move-in ready. There can't be falling ceilings, things like that. Advantages of conventional loan: so you could still get a low down payment. The PMI might be a lot lower, and then the houses don't have to be in that great of condition. Disadvantages: the loans are more strict. The grantor becomes lessee, and the grantee becomes a lessor under a sale leaseback. True, right? The seller sells it and then becomes a tenant. The FHA insured mortgage loan must likely obtain from the Federal Housing Administration. False, right? Why is it false? Because you could go to any bank to get an FHA insured mortgage loan. A buyer does not have to be a veteran to assume a VA loan. True. There's some spouses, some kids that have the right to their to the veterans' benefits as well. The FHA loan that will most likely have the lowest loan to value ratio. False. Conventionals could have low loan to value ratios as well. So here are vocabs. You could pause here. Here's more vocabs. You could pause here. Some more vocab that you could pause here. And then we went over and we identified, described, explained, and distinguished these objectives. Thank you, guys.